One of the more popular option strategies is the Iron Condor. What is the Iron Condor? Well, it's a directionally neutral trade, meaning you don't have to pick a direction. You don't have to pick if the stock is going to go up or down. As long as the stock trades in a range, in a pretty wide range actually, you make money. And that's what makes the Iron Condor such an attractive strategy is, as a trader, most traders don't have a magical crystal ball that can predict whether ABC stock is going to go up or down in the next 30 days or 60 days or whatever time frame it is you're trading. And that's where a directionally neutral strategy like the Iron Condor makes a lot of sense. So, option strategies explained. Today we're talking about iron condors and iron flies. Now, I did a previous video on option strategies explained where I discussed vertical spreads. And if you haven't watched that video, go watch my video about vertical spreads, because what iron condors and iron flies are, they're essentially a combination of a put credit spread and a call credit spread. So go check out the vertical spread video if you have not already. So what are iron condors and iron flies? Well, you can think of an iron condor as an option strategy that is directionally neutral. You don't have to pick a direction, and you really can think of it as a combination of a put credit spread and a call credit spread, both spreads sold at the same time. So there's 4 legs to an iron condor, right? There's 4 different options that make up the iron condor. If you want to, you can also think of an iron condor as being a strangle, but you buy 2 additional long wings to the strangle. That way you cap your risk. And if I go to these further slides here, I've shown these slides on the previous videos about vertical spreads. Remember the risk profile of the put credit spread? It's where you sell a put and then you buy a lower price put to cap the downside risk on that short put, right? Because normally a short put has unlimited risk to the downside, but by buying that put at a lower strike, you cap your downside risk. And with the call credit spread, it's essentially the same, right? You sell a call and then you buy a higher strike call to cap your upside risk, because normally a short call has unlimited upside risk, but by buying that extra call, you cap that risk. And so, a short strangle, of course, is a combination of a short put and a short call, right? And you have unlimited risk both to the upside and to the downside. But what the Iron Condor is basically that strangle, and then we buy the extra put and the call to cap our risk, right? So if I go back to the previous slide, you see the strangle, unlimited risk to the downside, unlimited risk to the upside, but by buying the 2 long wings is what we call these, right? We have capped our downside risk and our upside risk. Or again, you can think of this as a put credit spread, because that's what this is, a put credit spread, and this is a call credit spread. So let's talk about the max reward and the max loss on an iron condor. It's very similar to your put credit spreads and your call credit spreads. So basically what you want to do is figure out the width of the spread. So usually you keep the width of the 2 spreads the same. They can be different, but usually, for example, if you have a $5 wide put credit spread, you're probably also putting on a $5 wide call credit spread, and the max loss is going to be the width of that spread. So if it's a $5 spread, it's $500, right? Because options contracts represent 100 shares of the underlying stock. So if it's a $5 spread, your max loss is that $5 width minus any credit received. So the Iron Condor is a credit trade. When you sell an Iron Condor, you receive a credit. So if the width of the spreads are $5 and you receive a $1 credit, your max loss on the trade is $4, right? That's very easy to calculate in your head, but your trading platform, of course, is going to do all the calculations for you if you're not real good at math. But let's imagine you have a $10 wide spread, and let's imagine you receive a $250 credit on selling that Iron Condor. What's your max loss? Well, it's $10 minus $250. $750 is your max loss. So what's your max reward? Well, because it's a credit trade, the credit received is your max reward. So if you receive, $3 to sell an Iron Condor, what's your max reward? Well, it's the $3 credit that you received when you sold the Iron Condor. That's the most you can make. Let's talk about the break-even points. Now, because there's 4 legs to this Iron Condor, there's actually 2 break-even points. You have a break-even point down here for the put credit spread, and you have a break-even point up here for the call credit spread. Now, what the break-even points are going to be, they're going to be whatever your short strikes are plus or minus the credit received. So with the put, it would be your break-even point is going to be the put strike. Let's imagine that this is the 50 strike and you received $1 to put on the Iron Condor, well, your break even on the put side would be 50 minus 1, so it would be, $49 is what this would be. And on the upside, let's imagine the call was an $80 strike, and again, you receive $1 credit to put on the Iron Condor. Well, your break even's 81, right? So you get that $1 cushion on each side for your break even points. Looking at the table here, again, directionally, Iron Condors are neutral trades. Now, you can lean them one way or another. They don't necessarily have to be dead center neutral. You can skew them a little bit to make them a little more bullish or a little more bearish, but they're never going to be all that directional. They're very much a neutral trade for the most part. If you actually want to get directional in a trade, the Iron Condor is not a great strategy. There's much better strategies if you're actually wanting to make a call as far as bullish or bearish in direction. For volatility, you want to put on Iron Condors when IVR is high, because again, this is a credit trade. We receive a credit when we sell an Iron Condor. Thus, we want to receive the most credit possible. So we want IVR to be high. When IVR is high, options prices are high. And if we're selling options, we want prices to be high. So we want IVR to always be high when we're selling options. So put on your Iron Condors when IVR is at least 30 or above. If IVR on your underlying stock is 30 or less, it's probably not worth it to sell an Iron Condor because the premiums are just not going to be there. Now, one thing I do want to mention, and this is very important if I go back to the first slide, as a rule, you should always put on your Iron Condors as one trade rather than legging in, meaning you buy and sell all 4 options as one trade. You don't leg in one option at a time or 2 options at a time. And the same thing when you're taking your Iron Condors off. If you're closing the trade, close it all as one trade. Don't leg out of the trade by closing one option at a time. Close the entire position all at the same time. And again, this is very important on any multi-leg strategy like an Iron Condor where you have multiple options as part of a strategy. And the reason is you're just going to get the best feels by putting on all 4 options at the same time and taking them all off at the same time. If you try to get cute and, sell a put one day and then later buy a put to form a put credit spread, a few days later because the short put was going well or wasn't going well or whatever it happens to, and then later you sell a call credit spread and you end up forming an Iron Condor after a few days or even a few weeks of being in the trade. But if you went into it with the idea that you were going to put on an Iron Condor, you probably would have just got a lot better prices just putting it all on as one trade in the beginning, because you never know how the underlying is going to act. For example, if you put on the put credit spread with the idea that, the underlying is probably going to go up, and if it goes up, I'll eventually put on the call credit spread. That way I make my Iron Condor even wider. Well, who's to say that the underlying is going to go up after you put on your put credit spread? What if it goes down? Well, if you'd had the call credit spread on, it wouldn't hurt so bad, but you didn't because you were trying to leg in. Just don't get too cute with these multi-leg strategies. They go on all together, they come off all together, and that's just a rule you really need to stick by. Now let me switch over to my trading platform and let me show you Iron Condors in action. So let me go to an underlying I don't currently have a position on. Microsoft, I don't think I have a position on. So let's go to the options chain for Microsoft. I'm going to go out to the 52-day cycle. And, you could actually on TASTYTRADE, you could just go up here and do normal Iron Condor, hit go, and it will create an Iron Condor for you. You can just drag the options to the strikes you want, but that's kind of tedious because typically it's much easier just to click the bid and ask price on the options chains for the strikes you want. For example, I know typically I'm going to do them right around that 1 standard deviation mark, somewhere around, 16 to 20 deltas typically. So for this Microsoft position, I'd probably sell the 17 delta 365 strike put and then buy the 360 put here. So that's the put credit spread. You can see if I just did this as a put credit spread, I would receive a 69-cent credit. So $69 is my max profit, and it's a $5 spread, meaning my max loss is $5 minus 69. $4.31 is my max loss. That's not great risk reward. Now with a put credit spread or a call credit spread, you would actually want to move this closer to at the money to make that max profit and max loss, your risk reward, much more reasonable. But because we're doing this as an Iron Condor, we can get much further out because I don't have to make as much on the put credit spread, because remember, I'm also going to sell a call credit spread. So the two together will make the risk reward much more attractive. So let me go ahead and sell the call credit spread. And you can see now I'm getting a 159 credit. My max loss is 341. So I'm risking 341 to make 159. I'm essentially risking 2 to make 1. And for me, that's actually my preferred risk reward on credit spreads and Iron Condors. I like to risk 2 to make 1. Now IVR in Microsoft is not very high. It's only around 27, so IVR is not great. I'd rather put this on when IVR is a little higher, but you know, Microsoft has already had earnings this cycle, so that's why IVR is not very high. But here is the risk reward profile on that. If I were to put this on, again, because it's a directionally neutral trade, as long as the stock finishes in this range, you know, in between our short strikes, plus or minus the credit received, you know, and so we get a little bit of a cushion because we received $1.60 credit. So it's not 365, it's not our break even. Remember, we have $1.60 below 365 is our break even. So it would, our break even on the downside is really 363.40, and our break even on the upside would be not 425, it would actually be 426.60. But you can see we have the potential to make about $160, and if we lose, if it finishes outside the range, then we lose 340. So it's a defined risk trade. You know exactly going into an Iron Condor what you can make, what you can lose, and it's never going to change on you. Your buying power requirement's never going to change. Your buying power requirement on an Iron Condor or any defined risk trade is always your maximum possible loss. So if my max loss on the trade was 340, that's the buying power reduction, and it will never change over the life of the trade. You're never going to wake up one day and your buying power requirement's going to, you know, jump up and, you know, shock you. You know, you don't have to worry about that with defined risk strategies. One related trade I want to discuss briefly is the Iron Fly. Now, the Iron Fly is essentially an Iron Condor, but it's a special kind of Iron Condor. It is an Iron Condor where your short put and your short call share the same strike price. So it's basically just a really tight Iron Condor. So Iron Fly would be me selling that put and selling that call. And then if I wanted to still make it a $5 wide, you know, I could buy that put and buy that call, and that would be the Iron Fly. And its profile looks a little different. Let me zoom in a little bit, because instead of that flat plateau here, now because the two short strikes are at the same strike, we have this pyramid, right, this tent in the center, and our max reward is much greater if we nail exactly that strike. Now, the odds of you nailing exactly that strike and making the maximum possible reward on an Iron Fly is very unlikely, but you really don't have to make the maximum possible reward. Even if you finish somewhere in the middle of the tent, you're going to make quite a bit of money on an Iron Fly, because what this is, it's a really tight Iron Condor, meaning you receive a ton of credit for this thing. Because if we clear this out, remember when I was going out here to like a one standard deviation kind of Iron Condor, I was receiving 158 credit. Well, now if I bring these strikes all the way into at the money and then still keep the wings $5 wide to cap our risk, you can see our credit jumps up from about 160 to 473, right? So we're talking about, you know, 3 times as much credit for this thing. So that is the Iron Fly. Now, that's not just free money, right? Obviously, we get 3 times as much credit, but our POP, our probability of profit, is only 10%. Now, we only are going to win on this trade about 10% of the time, because we have to nail this, you know, in this range. We only have like a $10 range for Microsoft to land in for us to make any money, right? And to make any significant money, it really needs to peg that 395 strike. So for an Iron Fly, you're typically not going to keep these wings just $5, right? You want to bring these out quite a bit. Let's make this $25 on each side. So if I do that, you can see now I'm receiving 1757 in credit, a ton of credit. My max loss is 742. Well, hey, that's great. My max profit is more than my max loss, but again, probability of profits 38%. If you look at the risk profile on this, you know, we have a much bigger tent. Let me zoom back out. We have a much bigger tent to land in, so we stand a much better chance of eventually making something. Now, again, this credit is a little deceiving. Yes, it's a huge credit, 1757 in credit, but you know, that's the max reward if you nail this 395 strike. The likelihood that you're actually going to hit that strike on expiration. Most people are never going to hold any of these trades to expiration. You typically don't hold any options trades to expiration. That's not a good idea, especially options trades like Iron Condors and Iron Flies. You're going to treat these just like most of the other trades we've talked about. You'll put them on around 45 days to expiration, or maybe go out to 60 days to expiration, but then you're not going to hold them all the way to expiration. You're going to be out at typically around 21 DTE is a good time to get out. So you're not going to hold these things and try to nail the max profit. If I were to actually sell this Iron Fly, what I would want, I probably just want to take $1 or $2 out of this, right? If it got to the point where I could take $2 out of this, I'd probably take it off, because it's so unlikely you're ever going to really, hit that high tent area, but it is very likely you will finish outside the profit zone altogether and not make any money. So if it got to the point in this trade where I make $2, maybe $3, I would definitely take it off. So that's the Iron Fly. I actually don't trade a lot of Iron Flies. I trade much more Iron Condors, and the reason I do many more Iron Condors is because you can get so much wider, right? The Iron Fly is essentially a straddle with some wings, where the Iron Condor is a strangle with some wings, so you have this huge profit area with the Iron Condor. One of my favorite strategies is with earnings trades. For example, today, I know we've got some big earnings as I'm recording this video. AMD reports after the bell, so does Amazon reports after the bell today. If I were to go to Amazon, and if I went to 52 DTE, Amazon's IVR is 74. That's super rich as far as the options premium. So I would have no problem doing something like selling that 160 put, buying the 155 put, and then going up here to the calls and maybe selling the 200, buying the 205. I receive $1.81 credit. My max loss is only $3.19. That's pretty good risk to reward. And also because it's earnings, this high IVR is high IVR because earnings is right after the bell today. Now, after Amazon reports, what's going to happen to IVR? Well, tomorrow's IVR is going to come way down, because after earnings, all the risk is out of the trade, right? The stock's not going to move around as much after earnings. So IVR is going to come way down, meaning these options are going to come way down in price. So, I sell them really high, and then I buy them back to close at really cheap prices. That's how you make money selling options, right? The risk profile here doesn't look right because I've got some other Amazon positions on. If I go to the analysis tab, turn everything else off, but this potential Iron Condor, that is a trade I would consider putting on. Matter of fact, I may actually put on that trade now that I take a look at it. That is a pretty attractive Iron Condor. So that is an overview of the Iron Condor and the Iron Fly. So the Iron Condor and then the Iron Fly, they're directionally neutral. They need to be put on when IVR is high. And the great thing is they are defined risk trades, meaning you know exactly going in what you can make and what you can lose, and it's not going to change on you. So a lot of especially newer traders and certainly risk averse traders, they love the Iron Condor just because it's the kind of trade you can put on and you can sleep like a baby at night. Now, if you want to learn more about options trading, especially my favorite options trading strategy, the wheel options trading strategy, check out my book, The Super Wheel Options Strategy, available on Amazon. There'll be a link in the description below. Peace, guys.